Good afternoon to all of you. This is Ranjan from smartfinancing.com. And this video is getting recorded on 4th of November 2024. And when I am recording this video around 1 o'clock 8 minutes, the Nifty is around 420 point down and the Sensex is 1200 point down. So this is a phenomena in the market, and I am just going to give you a very good trend analysis of the pair trade. So before I go to the pair trade, try to understand what is the risk one person should have in the future trade, and I request all of you view this video till the end. If you are involved in the future and option trade, so you have these three prime risks, and beyond that also you have many other risks. But these three are the prime risks. Daily M2M, mark to market margin. Suppose if you have bought a future, every day future is being falling. So you need to arrange M2M, mark to market margin on the day end to keep the position alive, or else the broker will close this position. Second, extreme volatility risk. Suppose you have taken, so now we are recording it on 4th, tomorrow is the US election result. Suppose Nifty itself is falling by 5%. There is a 5% fall in Nifty. So many stocks will crash. They will come to 15-20% fall. What will happen? So if your M2M is adjusted, the extreme volatility condition, the broker will close your position. Even though if you have the option hedge, still your position will be closed, because M2M used to get monitored on real-time basis. Third is the trend risk. You have estimated a trend using any of the methods, say moving average, indicator, Elliott study, Falana study, hundreds of study you utilize, and you said that the trend is up or down. However, after you enter the trade, the trend has not obeyed your principle and gone against you. So these are the three major risks you are having as a future trader. Even though you hedge the trade, but this risk still persists in your trade. It remains in your trade. So this risk of arranging fresh capital, risk of extreme volatility and arranging the fresh capital for that, risk of identifying a trend and that analysis getting failed. These three are the prime risk, and these three risks will not be nullified with the option hedge. Rather, you require specific arrangement to nullify all these three risks. So pair trade comes in picture in there. So if you want to nullify all these three risks, then you require the help of the pair trade. So pair trade can be done in many different ways. So many people knew the price ratio method. So they divide the price of company P and Q. If there is a companies are there, they divide their price, and they found out that if they maintain a proper ratio and that ratio deviates certain point of time, they enter to a pair trade. That is a crude method of entering a pair trade, most inferior method of entering a pair trade. So to enter a pair trade, you require some advanced analysis. You require beta decoupling analysis. You require Z-score analysis. You require correlation, alpha, Johnson's alpha, Sharpe ratio, Turner ratio, spread, all type of analysis you require to do that. And to your surprise, you'll be knowing that we have a software which is Smart Finance product, and this beta decoupling is my own innovation, Mr. Ranjan's innovation. And this particular software has all attributed to do the analysis in click of mouse. I am going to demonstrate today, take the record of all these things and follow it for 5 to 10 days, then you will know what is the success of this method. All this study, whatever I mentioned, all studies will be covered here. So here, first I am going to the NSE site, and I got that the stocks are down. So 46 stocks are down, 4 stocks are up. And I found out that some auto segment stocks are leading in the fall. However, bankings are not left out. You can say Axis Bank 1.75% down, ICICI 1.5% down. And same way, if I go for the HDFC Bank also, somewhere that HDFC also will be down by certain percentage. You have HCL down, HDFC also 0.85% down. So this is the trend for the today, and except a few companies, Mahindra and Mahindra, Dr. Reddy's and certain things, only 4 to 5 companies are positive. Remaining all are there, so negative. So this is how the trend for the day when we are sitting and analyzing. I am going to my software. The default stocks ICICI, HDFC, Axis, and 28 November I am loading the data and analyzing the things. So whatever the things I have told you, beta, alpha, Sharpe ratio, Johnson's alpha, Trenner ratio, correlation, beta decoupling, all these 5 analysis is being done, and this is the price is being taken. Their volatility based, they are being arranged. Their uptrend projection happened, downtrend projection happened. So this is for your information. So Johnson's alpha, Sharpe ratio, Trenner ratio, beta decoupling, all gives one count. So this is count number 1, first analysis, second analysis, third, fourth, and fifth. 5 analysis we are doing. Out of this 5 analysis, if I go to the first pair, first Axis and HDFC, so 4 studies are telling that buy Axis, and 1 study is telling that buy HDFC, and 4 studies are suggesting that sell HDFC. So you have to buy Axis and sell HDFC, same value. If you are 1 lakh worth of the contract value is 1 lakh here, 1 lakh you have to sell it here. Based on that, you have to adjust your lots. So then the entries, it is telling buy Axis in this range, hedge it with some put option equal to 1125 strike or less than that. Sell HDFC, hedge a call option with a strike 1767 level. So one OTM call and one OTM put it is suggesting to hedge and exit these things or book the profit. That is the first pair. Second pair, Axis and ICICI, it is suggesting Axis clean majority, Axis to be bought, ICICI to be sold, and here too also hedging recommendations are being given based on its strike. Exit recommendations also is being given. HDFC, ICICI, if I go 50-50, so 2 studies buy and it is a neutral pair, so I will not be choosing here. So this pair is now being rejected. So out of these things, the best pair is Axis and ICICI, and this is what it is recommending. ICICI Axis is buy, ICICI is sell. This is the range it is telling to buy. This is the range it is to sell. Market price will be slightly different. Keep a note of this thing and give your view where it is standing after 5 or 10 days, along with its hedging component. Similar way, you can go for if you want the TCS and Infi, and you are going for Tech Mahindra. So this also you can go load the data, and once the data is loaded, the analysis will happen. So analysis automatically it will happen. These 3 pairs, clear majority goes for TCS buy, Infi sell. Tech Mahindra and TCS, again TCS buy, Tech Mahindra sell. TCS is having lead in buying in both the analysis. When it go for Infi, Tech Mahindra, so Infi buy, Tech Mahindra sell. So this is what it is telling. Any of this pair you can take. Any of this pair you can take. I am just keeping it hold for a couple of seconds so that you can see the price. You can see the put option to be hedged. So TCS, Infi, this is the recommendations, and TCS, Tech Mahindra, this is the analysis. TCS and Tech Mahindra, and Infi, Tech Mahindra, this is the analysis. So keep viewing this particular video, share with your friends, initiate these trades in the paper trade format, and give your feedback on these trades after 5 or 10 days. And all these things you can able to learn and expertise yourself. And learning this thing, we have a fantastic F&O course which comes with all these learnings, how this analysis will happen, how when you should enter a trade, when you should not enter a trade, all things in detail. This pair trade methods is being explained. If you do not have a software, you can do it with your Excel sheet by updating the data also. We are also giving the Excels along with the course. So here, few hours of learning, you can manage all these risk. M2M risk will not be there because one counter you are bought in, another counter you are sold in. M2M daily M2M will be taken care of. Extreme volatility risk will not be there because one counter is rising means other will be falling, or one is falling means other will be rising. That will be managing the things. Trend risk also will not be there. If trend changes in the same sector, it will affect all sectors. So this is how, if you can, and hedging also will be there. So your buying value and selling value is equal. So you make money through the recoupling effect of the beta, recoupling effect of alpha, recoupling effect of correlation. So these are the mathematical factors gives you the profit. So think on this trade idea, and this kind of more the volatility, more will be your rewards, and this will be a excellent technique to work on. And not only that, those who have joined our programs and other things, they follow, and one group of the traders learn it very nicely. Those who have learned it in last program, see one of the things here is telling that, see 42,795 profit is sitting in the Nifty and Bank Nifty. It is one of our participant he has given, and adjustment he is asking about. It is a beta decoupling trade. So how many of you have taken this and made the things? It is only beta makes that money. So beta makes that money, and they debate, they discussed in this particular group, and they used to tell that it is 40k profit, beta is negative. So these are the ways one group of intelligent traders, those who have right attitude and aptitude to learn, they learn and make money. And simply those who do not take trade seriously and they do not analyze these three risks in their trade, they simply gamble and start losing money like anything. So you decide which team you want to belong. So the path is very simple. Take the course, learn it and use it, or else procure the software, do the analysis with the software and implement the trade and get benefited. And we are there to help you to achieve that success. Thank you very much. Thank you for your time.